Good morning and welcome to the Post-Monetary Policy Committee press briefing by the Central Bank of Kenya. The Monetary Policy Committee met yesterday, the 3rd of October 2023, and as usual, we're having a press briefing this morning that explains the rationale behind the decision and other matters of economic importance that will be led by the governor. As is customary with us, we ask you to please put in your questions through Slido. That's www.slido.com. The meeting today is hashtag MPC 1023, hashtag MPC 1023. And so without further ado, we'll give it over to the Governor of the Central Bank of Kenya, Dr. Kamau Thugge.
During its meeting on October 3rd, 2023, the Monetary Policy Committee retained the central bank rate at 10.5%. The Monetary Policy Committee noted that overall inflation has remained within the CBK's target range. The non-food, non-fuel inflation has remained unchanged and is expected to decline, which is indicative of easing underlying inflationary pressures. The impact of the tightening of monetary policy in June of 2023 to anchor inflationary expectations was still transmitting in the economy. The Monetary Policy Committee will closely monitor the impact of the policy measures as well as developments in the global and domestic economy and stands ready to take further action as necessary. The committee will meet again in December of 2023. Starting with the global developments, the global inflation, the rates in advanced economies have declined but remain above the respective targets due to persistent core inflation pressures and higher energy costs. U.S. inflation increased in August 2023 due to higher energy prices attributed to the rise in international oil prices. In India, inflation rose sharply in July and remained elevated in August 2023, driven by higher food prices. In the case of China, inflation remained quite low owing to weak domestic demand. With regard to core inflation, these have persisted in the major economies, but this is mainly due to tight labor markets, but also due to strong price increases in the services sector, particularly travel. Regarding the global commodity prices, these have remained below the peak levels witnessed in 2022, but oil prices have been rising. For example, the Melbourne oil price has risen recently from a low of 75, which you can see as of end of December 2022, and has risen up to the current prices of about 94.7. And the reason for this is because Saudi Arabia has decided to continue its 1 million barrels per day production cuts to the end of 2023, while Russia has extended its 300 million barrels per day export cuts during the same period. In regard to the global food inflation, we see that there has been a decline from the peak levels that were witnessed in 2022, except for a few items such as sugar and rice, largely reflecting ample maize harvests in Brazil and the US, and also lower palm oil prices attributed to higher output in South Asia. The main risk relates to the decision by Russia to end the Black Sea Grain Initiative and disruptions from the ban of rice exports by India. Sugar prices remain elevated due to concerns about the impact of El Nino weather on global production prospects and lower production in India. On the global economic outlook, the outlook remains quite weak, reflecting the impact of monetary policy tightening in advanced economies, the weakening demand in both China and the Eurozone, and heightened geopolitical tensions which continue to weigh down on economic activity. The growth outlook for 2023 was revised slightly upwards in July 2023, reflecting stronger consumption in the US and UK resilient services sector, including tourism, pent-up demand in Japan, and recovery in the supply chains. The IMF projections show that Kenya's real GDP growth is expected to remain strong in 2023. Just in terms of the numbers, we see that global growth will decelerate from 3.5 to 3% during this year of 2023. But we also expect activity to remain subdued and for global growth to be 3% also in 2024. But the main explanation for the slowdown in overall economic activity globally is the slowdown in the advanced economies. You can see, for example, the United Kingdom growth is decelerating from 4.1% in 2022 to only 0.4% in 2023. Similarly, for the Eurozone, we see a deceleration from 3.5 to 0.9% next year, and then a bit of a recovery in 2024 to around 1.5%. The emerging markets and developing economies, the growth remains about the same in 2022 and 2023, and just a bit of an increase in 2024. But the comparison I'd like to make is what is expected in the case of Kenya. We see Kenya's growth accelerating from 4.8% to 5% this year. These are the IMF's projections, not the central bank projections. In our case, we expect actually the economy to be much more resilient than that, and therefore we expect growth to be 5.5%, but we'll come back to that later. Talking about domestic inflation, the overall rate of inflation has remained broadly unchanged in September 2023. As you can see in that line, inflation has moved from 6.7 to 6.8. And the main reason for that is the slight increase in food prices from 7.5 to 7.9. We do see a slowdown in fuel inflation from 14.2 to 13.1. And for the non-fuel, we expect the outcome was no change from August at 3.7, and in September it recorded 3.7. In terms of looking at the composition of the inflation and the contributing factors to inflation as of September, we can see that food inflation accounted for 3 percentage points of the overall inflation of 6.8, and we see fuel contributed to 2.7, and then finally non-fuel only contributed to overall inflation by 1.1 percentage points. Regarding the non-fuel inflation, as I said, it remained stable in September and August, and this basically reflected the impact of monetary policy measures and the muted demand pressures. We can see that non-fuel inflation reached a peak of 4.4% around January of 2023, and since that time, reflecting the tightening of monetary policy, we see that has declined to 3.7 in July, in August, and has remained the same at 3.7 in September. In terms of the drivers of the food inflation, which has had a slight uptick from 7.5 to 7.9, we can see that the non-vegetables, the prices of non-vegetables has actually declined. The contribution has declined from 5.7 in August to 4.6 in September. And what has actually driven the increase in food prices is vegetables. And you can see that the share of vegetables in inflation has increased from 1.8 to 3.3 percentage points. So just focusing a little bit more on the drivers of the vegetable inflation, which, as I indicated, is what has caused the increase in food prices from 7.5 to 7.9. Looking at September, we see a sharp increase in the prices of onions, spinach, kale, tomatoes, cabbages, and potatoes. We see this as seasonal, and as soon as the rains return, we should expect to see a similarly sharp reduction in these prices. Just looking at the details of the drivers of vegetable inflation, you can see there onions. The price of onions increased by 51.2%. You can see the price of Irish potatoes also increased by 26.1%. Carrots also increased, cabbages, and then finally tomatoes. With regard to the non-vegetable inflation, we've seen fairly deceleration in inflation of these items, wheat, maize, milk, and edible oils, which have declined. Inflation has declined from 3.4, the peak of 3.4 in September of 2022, to actually deflation of minus 0.1 in September. The one area where the prices remain quite high, and if you recall, even when I was discussing about global inflation, we saw that sugar prices have actually increased quite significantly. In our case, sugar prices have risen by 58.1% through September, and basically contribute of the 7.9% food inflation. 2.5 percentage points is coming from sugar, only from sugar. And if you look at the overall inflation, we do the contribution of sugar to overall inflation is roughly about 0.8 percentage points of GDP. I mean of the overall inflation. Expectations. We have undertaken some agricultural surveys, and fewer respondents expect price of consumer goods to increase in the coming months due to favorable weather conditions. So just looking at 1 month ahead, the percentage of respondents who felt that within 1 month the price would increase has declined since July from 69.4 to 47.9. When we asked about the expectations about 3 months forward, the percentage of respondents that felt inflation was going to rise in the next 3 months has actually declined from 72.2% to 45.1%. So there's a general expectation that inflation will be decelerating in the next month and also within the next 3 months. Turning to the domestic economy, we see that the growth of GDP in 2022 was 4.8%, and that was driven mainly by a very robust increase in value added of services, which grew by 7%, but there was also a slowdown in the agricultural growth, which actually contracted by minus 1.6%. And the result was an overall growth of 4.8. This year, we are expecting agriculture to recover significantly and for agriculture to grow by 5.9% for the year as a whole. We expect services sector to remain quite resilient and to grow by 6%. And the combination of services of 6% and recovery in agriculture, we do expect real GDP this year to increase by 5.5%. In terms of the composite leading indicators, point to continued strong growth performance, and what that chart indicates is what the composite index of economic indicator estimates will be the actual GDP growth, and you can see the CIEA is in blue, and the actual GDP growth is in yellow. And you can see that the composite index tracks closely the real GDP growth. So using a composite index, we do estimate that in the second quarter, we expect real GDP growth to be about 5.6%, and in the third quarter, we expect real GDP growth to be about 5.5%. And therefore, we still feel that we should be able to achieve the real GDP growth of 5.5% by the end of the year. Just to give some examples on the agricultural production, the agricultural sector has rebounded significantly in 2023 with increased horticultural exports, tea production, and milk intakes, reflecting the improved weather conditions. As you can see, the total horticultural exports as of August compared to last August have almost doubled. The increase has been 94.8%. Similarly, for tea production began the year on a negative note, but we have seen some recovery, and by July, it had, compared to July of last year, it increased by 32%. And similarly, for milk intake, we have seen some recovery from earlier part of the year where growth was negative. But now we see, at least since June, some positive growth compared to the previous year. Again, for the agricultural production, the key food crops in 2023, we expect maize, for example, to increase by 29.3%, which translates to an increase in the number of bags of production from 34.3 to 44.6 million bags. For wheat, we expect an equally significant increase of 62.6%, from 3 million bags to 4.9 million bags. Rice will continue to struggle because of the floods that were experienced. Beans, again, robust growth by 56.3%. Irish potatoes and sorghum, and also millet. These are statistics from the Ministry of Agriculture. With regard to the credit to the private sector, it remains quite resilient. There had been a slowdown in July from 12.2% in June to 10.3%, but in August there was a recovery to 12.6%. And this increase in credit to the private sector was virtually going to all sectors that I just referred to a couple of minutes ago. So, and just to give an example, in the case of the manufacturing sector, we see that the banking sector credit to manufacturing increase in August 2023 by 19.6%. In the case of trade, we see credit from the banking system to the private sector and specifically to the trade sector, increased by 9.4%. Transport and communication, it increased by 25%. And consumer durables continues to experience credit expansion. And as of August 2023, it was 12.7%. Now, moving to the balance of payments, I know it's a bit difficult to read there, but the balance of payments, we do expect the total exports to increase slightly, mainly as a result of an increase in tea exports. We are expecting horticulture to broadly remain unchanged, although the volumes of horticulture increase. The prices have not performed as well, partly maybe because of the reduced demand in the Eurozone. As I indicated earlier, the projection for growth in the Eurozone has decelerated quite significantly from last year. With regard to imports, and we'll have a bit more details on with regard to imports, we expect a slowdown in imports, and the combination of the increase in a bit of increase in exports, not very much, but the sharp reduction in imports has resulted in an improvement in the trade balance. And that trade balance, we are able to, this year, we're able to cover that trade balance with a combination of surplus in services and surpluses in the financial account. The bottom line then is that we are moving from a deficit last year of 2.1 billion to a surplus balance of payments of 1 billion, and I think we'll probably come back to the details. So the current account continues to narrow. As of 2021, the current account deficit was 5.2% of GDP. Last year, it narrowed to 5.1%, and we expect that by the end of this calendar year, the current account will again narrow further to 4.1% of GDP. And the rationale for this narrowing is, first, we do have we had an increase in the 12-month exports increased by about 0.5% through August. But comparing January to August of last year compared to January, August of this year, we have experienced a slight decline in the value of exports by minus 2.2%. And this is just a bit of a detail table just to show you where the growth in exports were. You can see food and live animals, we didn't export that much. Through January to August was 1.2%. But the thing to really point out is the mineral fuels, which have increased by 39.6%. Chemicals and related products, and especially medical and pharmaceutical exports, which increased by 18.5%. And then finally, manufactured goods, particularly to the regional market, and especially to Uganda and also to Rwanda, we see that the cement exports have increased significantly by 83.3%. And this is just an example of, again, of the manufactured exports in the region, and we can see that there's a fairly significant increase in iron and steel, and also non-metallic manufacturers. And you can see that is going to the, basically to Uganda as well as to Rwanda. Now, with regard to imports, I did mention there is a contraction. We have seen a contraction in the value of imports. For the 12 months to August, we saw a huge deceleration from 19.6 billion to 17.3 billion, which represents a reduction in imports of almost 12%. And comparing the January to August period of 2022 to the same period in 2023, we also see a sharp slowdown in imports of 13.8%. Now, what is explaining that reduction in imports is the food and live animals. We actually have experienced an increase in food and live imports by 28.3%. And indeed, the increase in food imports has also helped us reduce the pressure on food prices. But virtually everything else that we are importing is actually going down. You can see minerals, fuels, and lubricants have gone down by 19.9%. Animal and vegetable oils have also declined by 20.9%. Chemicals and related products have also declined by 14.3%. Manufactured goods have declined. And similarly, the machinery and transport equipment have declined by 18.9%. And we have broken down to the specific items that were affected. Okay, so this is just an example of the machinery and equipment. You can see that in the case of India, there was a slowdown, but most of the slowdown was from China. We reduced our imports of machinery and transport from China. In the case of road vehicles, you can also see there was a reduction in imports of vehicles from Japan, and also from India, and also from China. Now, looking at the services exports, travel receipts have been resilient in 2023, and this reflects improvement in international travel. This just gives you the monthly travel receipts. The blue line indicates the pre-COVID travel receipts. And you can see even from the beginning of the year, from January, February, March, even April, May, and June, essentially we had gone back to pre-COVID levels of travel receipts. They have slowed down a little bit in the last 2 months, but we do expect this to recover. And indeed, we are expecting this year to be a very good year for travel receipts and for tourism in general. This is the number of tourist arrivals in thousands, and you can see that tourist arrivals increased by 55% in August 2023 compared with August of 2022, and this was supported by the recovery in international travel. With regard to remittances, these have remained strong, growing by 3.2% in the 12 months to August 2023. Compared to a similar period in 2022. So for the 12 months to August this year, we had the inflows of remittances of 4.1 billion compared to roughly 4 billion last year in the 12 months to August of 2022. And maybe just to go back to that slide, for the period January to August of this year compared to last year, we have seen an increase of 3.4%. And we'll see later that what we are projecting that diaspora remittances to continue to be fairly robust and resilient. And we expect an increase of 4% in remittances for this whole calendar year. This is just, I referred to this earlier, to focus on the financial account. This is what is funding the current account deficit, and you can see The financial account, we are moving from actually a surplus. I know the minus there is actually means a surplus. It means an inflow into the economy. So we are seeing an increase from $4.1 billion to $5.2 billion. And that includes both the direct investments as well as portfolio investments, and also our any loans that we might have from the development partners. And the bottom line there, as you can see, under the overall balance of payments, we move from 2.1 billion, which is a deficit, which is reducing. It's a reduction in the accumulation of our reserves, to a surplus of 1.061 surplus in the overall balance of payments, which is a buildup of our international reserves. So, and with that, we see that the level of the CBK's usable foreign exchange reserves remain quite sufficient at 6.9 billion, which is equivalent to about 3.7 months of import cover. Just quickly on the fiscal performance. The envisaged fiscal consolidation over the medium term is expected to reduce growth of public debt and boost debt sustainability position. And you can see there has been a fairly, since 2020, 2021, you can see there has been a significant reduction in the fiscal deficit from 8.3% at that time to roughly 5.9 in 2022, 2023, last financial year. And this year we expect that to go down to 5.4%. I know there was an earlier figure that was lower, but we have since revised the value of interest payments, which has increased the fiscal deficit, but it has not changed the primary deficit. So by the year 2027, 2028, we do expect the overall fiscal deficit to have declined to 3% of GDP, which would be consistent with achieving our debt target of 55% of the net present value of debt relative to GDP. Again, this is just the fiscal framework. I don't think we really need to go into the details. But just again, that we are reducing the fiscal deficit from 5. We're moving to 5.4% in the current financial year of 23-24. And then in the following year, we expect that to be reduced to 4.4% of GDP. And again, as I just indicated, over the medium term, we do expect to achieve a deficit of 3% of GDP, which, by the way, is consistent with the EAC convergence criteria. So I think that's the end of the presentation. Thank you very much.
Thank you. That was the Governor of the Central Bank of Kenya, Dr. Kamau Thugge, taking us through the thinking that the Monetary Policy Committee had as it met yesterday and made its decision. And as usual, we want to go straight into questions and answers. We already have some that have come in. And just a reminder, please put in your questions through Slido, www.slido.com. The meeting today is hashtag MPC 1023. That's the month of 10, the year of 23. And jumping straight into the questions, we begin with Kefa Moirore from the Business Daily. Kefa is saying, or asking rather, is CBK concerned, in his words, of things breaking from high interest rates? Treasury bills and lending rates have been stuck up despite signaling in reduced domestic borrowing and inflation. So the question about the high interest rates. Brian Ngugi from the Standard newspaper is asking, has Kenya cancelled the plan to repurchase a portion of the $2 billion Eurobond? Are the current global credit market conditions favorable for refinancing that Eurobond? And finally, for this batch, Kefa Moirore from the Business Daily, again, how many banks have gotten the nod for risk-based pricing so far, and what could explain the long wait for some of the approvals?
Let me start with Mr. Moirore's observation about whether the CBK is concerned of things breaking from high interest rates. Of course, we are concerned about high interest rates. However, it's important to point out that credit to the private sector through August did increase to 12.6. In terms of some of the measures that the government has announced in the last few days, which have included the sharp reductions in expenditures. We have engaged with the KRA on additional revenue, collection of additional revenues, and we believe that these actions will stem the increase in interest rates on T-bills. In addition to that, we are working very closely with our development partners, and we expect an inflow of resources within the next 2 months, and that should ease the pressure on domestic borrowing. So yes, we obviously look at to ensure that interest rates don't, get out of control, but we do believe that the measures that have now been taken will indeed stem the increase in interest rates on treasury bills. Mr. Ngugi's question is whether Kenya cancelled the plan to repurchase a portion of the 2 billion Eurobond, and are the current global credit market conditions favorable for refinancing the Eurobond. I think just answering the last part of the question, I think currently the credit market conditions are not favorable for refinancing the Eurobond. And therefore, as you all know, we have been engaging our lead managers and lead advisors on how to address the issue of the 2024 Eurobond. We have looked at several options. We are talking with multilateral institutions, with the World Bank and the IMF, to see how much additional resources they can make available to us. We are speaking with the regional development institutions to see how much additional resources they will become available. And so we are actually building our war chest, so to say, to address the issue of the Eurobond. And we do expect that between now and June, that we will progressively reduce the liability of the Eurobond, so that by the end of June, if necessary, we will be able to use our international reserves to make sure that there's absolutely no doubt about the government being able to pay for this for the Eurobond and to take out that liability. I think on the again, this is Kefa Moirore, on the issue of the banks that we are still working with the banks. I believe we have over 30 banks have now we have agreed with them on the risk-based pricing, and we'll continue to engage the others so as we can complete this process as quickly as possible.
Moving on to the next batch of questions, we start with Herald Alo from the People Daily. He's saying there's a fresh decline in foreign exchange reserves. What is causing this drain? Jimmy Mbogo from KTN, he's asking, some banks' risk-based pricing models are yet to be approved, and what's the reason for the hold-up? This, I believe, was answered previously, but also he continues to ask, what is the cause of rising non-performing loans? Eric Mokaya from Mwango Capital is asking, are you worried about the sticky non-performing loans issues in some banks?
Yes, let me start with Mr. Alo. Yes, indeed, there is a slight decline in our foreign exchange reserves, and partly that reflects the debt service payments. Having said that, I did indicate in my presentation that the level of reserves is about $6.7 billion. It's about 3.7 months of input cover. We have a flexible exchange rate system. So we believe strongly that the level of international reserves is actually sufficient to deal with any short-term shocks. I think I've covered the issue of the risk-based pricing. We are engaging the banks that we have not agreed with, and we hope that we can conclude that process as quickly as possible. Yes, the NPLs is an issue of concern to us. We are keeping a very close eye on it. The NPLs have increased from roughly 14.2 in August of last year to the current 15%. The banks are provisioning for it, and we are engaging those banks that have the high NPLs just to make sure that they are making the right provisions, enough provisions, and just really making sure that they have a plan on how to address the NPLs.
The next batch of questions will begin with Charles Moneki from the Business Daily. Charles asks, is the depreciation of the shilling a factor in the sharp fall of imports, or sharp fall in imports this year? Peter Mboro from the Daily Nation says there's a surge in forex bureaus operating the CBD. I believe this is CBD of Nairobi. What has driven this, and what does CBK attribute this to? Finally, from this batch, A. Terry from Modern Monetary Lab says capital flows are positive, diaspora remittances are at an all-time high, exports are robust while imports are falling. Why has the Kenya shilling depreciated by a 20-ish range?
I think it's starting with Mr. Moneki's observation, whether the depreciation of the shilling is a factor in the sharp fall in imports this year. I guess the simple answer to that would be yes. Normally, the way the exchange rate depreciation works is obviously to incentivize exports and also to make imports more expensive, so that you slow down imports and reduce the demand on the foreign exchange, and therefore reduce the pressure on the exchange rate to depreciate. So that is clearly one of the factors. But there are other factors, as I indicated, even on the reduction in machinery, equipment and machinery. That partly reflects the fact that the government has finished some of these projects, and therefore is not importing as much machinery and equipment as it was doing before. So there's a combination of factors that have led to the reduction in imports. Others have to do with some of the measures that we have put in place to incentivize local production. And we have seen in some cases where local production has actually picked up, and we can also see the increase in exports of manufactured items to the region. And so to a certain extent, those measures that have been put in place to reduce some imports and to incentivize local production appears to be succeeding. I think let me, on the issue of the capital flows, the capital flows are positive. Diaspora remittances at all-time high, and exports robust, with imports are falling, while the Kenyan shilling depreciated by 20%. Maybe just to take Mr. Terry back on the genesis of the depreciation of the shilling. And you may recall, and not going too far back, but you may recall that there was, after the global financial crisis of 2008 and 2009, the US and other advanced economies eased monetary policy significantly, and in fact came up with a term of quantitative easing. And that continued to even to the up to COVID-19, but that expansion of money supply then subsequently led to inflationary pressures. And indeed, inflation in the US reached a peak of 9.1%, which is probably the highest it has been for perhaps the last 50 years. So the reaction from the Federal Reserve Bank and other central banks was to raise interest rates very, very significantly and very, very rapidly. So, for example, the US raised its federal funds rate by 500 basis points over a fairly short period of time. In Kenya, we raised it by about 250 basis points. We were a bit slow. And so the result was all currencies globally actually depreciated. It was not just the Kenyan shilling that depreciated. And part of that depreciation came from portfolio outflows. Since that time, or at least in the last few months, we have seen, as you have indicated, we have seen a fairly sharp slowdown in imports. Exports they are doing okay, although they could be doing better. Remittances are doing well. Travel is doing well. And so I think going forward, particularly also with the actions that we've taken on the fiscal side, we should be able to see less pressure on the exchange rate. We are, and as I said earlier, with regard to the Eurobond, we are also in discussions with our multilateral development partners, our bilateral development partners, the regional banks, with the expectation of additional external resources. And so that combination of additional resources, an improvement in the current account deficit, which I just mentioned, which is now moving from 5.1% to 4.1% this year. We therefore expect a slowdown in the depreciation of the exchange rate. And we've seen also a deceleration in the depreciation in the last few months, and I think this will continue in the next 1 month or so.
The final set of questions, we go back to Jimmy Mbog of KTN. Jimmy says, or asks, what are the facilities extended to Kenya over the last year, and are you concerned about our debt carrying capacity amid rising interest rates? The final one is from a student at the University of Nairobi named Davis, who asks, from your assessment, when can we expect stability in Kenya's foreign exchange rates, or in Kenya's foreign exchange? Does CBK operate with a clean float or a dirty float? I suspect Davis is an economics student.
Okay, let me start with the question from the student. Basically, the question is about when we expect stability in the Kenya's foreign exchange, and whether the CBK operates clean float or dirty float. The CBK operates a flexible exchange rate system. That means the value of the shilling is determined by market forces, by supply and demand. When there is excessive volatility, we will go into the market, but just to slow down that volatility, not that we aim for a particular level of the exchange rate. So from that perspective, that is the way we have operated the exchange rate system. As I've just indicated, in terms of the stabilizing the foreign exchange market, we have seen the demand for foreign exchange suddenly from imports has declined. We have seen some receipts, whether it's remittances or travel, doing quite well. We have seen a slowdown in the increase in U.S. interest rates. And of course, we have, in our case, we did raise interest rates quite sharply in June. And so that gap between the U.S. interest rates and our interest rates has been narrowed to a certain extent. And that has slowed down the outflow of portfolio capital. In addition, the financing that we are expecting from our development partners within the next 2 months or so, all of this should combine to bring more stability to the foreign exchange market. On the facilities extended to Kenya over the last year, and whether we are concerned about the debt carrying capacity amid rising interest rates. Certainly, we are certainly concerned about our debt carrying capacity from the rising interest rates. I have indicated that the measures that the government has taken in the last few days should contain the increase in interest rates with the cutback in expenditures, the focus on revenue mobilization. That combination should bring about liquidity in the system, at least for the national government, and will lower pressures on interest rates. And again, as soon as the financing we are expecting from our regional development partners, and here I'm referring to the Afri-Exim Bank and the Trade Development Bank, where we have we've been having discussions, and those discussions we made a lot of progress. And so we do expect some disbursements within the month or a month and a half. That again will ease pressure on not only interest rates but also on the exchange rate.
Thank you very much. That brings us to the end of today's press briefing. This is a press briefing that we have after the Monetary Policy Committee meeting that took place yesterday for the month of October. As the governor says, and as he says in the press release, we expect one more meeting of the Monetary Policy Committee, and that will be in early December. But as is usual, the MPC stands ready to meet where the need to arise. But for now, we want to leave it there. Thank you so very much for joining us this morning into this afternoon, and we hope to see you before the end of the year at the last MPC briefing. Good afternoon.